This lesson looks at another crisis case study, that of Thailand in 1997, which kind of sparked the whole Asian financial crisis. So, like other emerging markets, which underwent a balance of payment crisis, Thailand displayed clear vulnerabilities and symptoms of a balance of payments crisis. So in terms of just generally looking at the framework that we've looked at on GACSU, Thailand's crisis was a classic example of a balance of payments crisis in which there was an overvalued exchange rate. That overvalued exchange rate led to a current account deficit, and that current account deficit was typically funded and financed by hot money flows rather than very stable financial foreign direct investment. At the same time, there was rising debt. The country saw falling reserves, which is pretty bad because your reserves are your buffer. So what typically happens is when your current account is in deficit and then your financial account turns into deficit as well, then you have more money leaving the country than entering, and your reserves fall, reducing your external buffers and increasing vulnerabilities. There was a mismatch on the balance sheet, either currency or maturity, and there was an erosion of policy credibility and poor regulation. So in Thailand, we start off, there was an overvalued exchange rate. So there were lots of devaluations in the 80s, and then the Thai government adopted a fixed exchange rate, and it was packed to a basket of currency, especially the US dollar. What happened was the baht started to appreciate. And since the baht was overvalued, it made Thai products less competitive and it hurt exports. At the same time, because your currency is stronger, you import more, and that causes a huge trade deficit. And in the end of the crisis, of course, after several speculative attacks on the currency, the government was no longer able to finance its current account deficit and abandoned its peg. So there was an overvalued exchange rate to start with, which created vulnerabilities in the economy. The first one, of course, was the current account deficit. So because of the overvalued exchange rate, in 1996, the current account deficit came in at 7.6% of GDP, and that's very large, and that was driven by a trade deficit of almost $9 billion. At the same time, in order to plug that or to finance that current account deficit, there was a lot of hot money flows, and that was a lot of short-term borrowing. So because of high interest rates and the fixed exchange rate, it attracted lots of short-term investment. But they didn't lend it for the long term in terms of foreign direct investment. It was more into the portfolio and bond market, and it was very short-term in nature. At the same time, many corporates discovered that they could borrow on foreign markets using borrowing in dollars at about between 5 and 8%, rather than borrowing domestically, in which interest rates were much higher at about 13%. And because the exchange rate was fixed, they said, oh, well, I'll just borrow at 5 or 8% and pay it back. Because it's fixed exchange rate, they thought there was no risk. But because they thought there was no risk, they borrowed lots of money and just put it in Thai deposits, in Thai banks. But the problem was that after the crisis of Mexico in 1994, investors started to become a bit more jittery around emerging markets and were a little bit more discerning in terms of where they wanted to put their money. So, hot money flows could have started to weaken a little bit. So there was also a large increase in private sector debt, and of course the problem is if there's a lot of private sector debt and private sector can't pay it back, then usually the government tries to step in and debt becomes absorbed as part of the government debt. The problem is at some point, or typically the government takes over the debt, so you also have to keep an eye on what's happening in terms of debt trends in the private sector. In 1992, there was a broad liberalization of the financial market, and the government deregulated the foreign exchange market, and local and foreign commercial banks were able to kind of deposit money in Thailand and borrow. And what happened was people or corporates and banks started borrowing in dollars and depositing it in local banks, or even lending it to corporates. And what happened was there was a lot of borrowing, and government debt increased from about 34% in 1990 to about 51% in 1996. As I said, most of the debt was generated by the private sector. 80% of debt was was from the private sector, and almost 36% was short-term. So it matured in 12 months or less. So that was setting it up for a currency mismatch, a maturity mismatch and a currency mismatch. So at the same time, Thailand started to see falling reserves. So a lot of the inflows into the financial and capital account were short-term. There were speculative investments into the equity market or the bond market. And once speculation against the baht started to rise, and investors started taking their money out. And the problem was, because the current account was in deficit and then the capital account and financial account flipped into deficit, it put a huge dent into the country's reserves. So reserves started falling. And actually reserves fell from 37 billion in 1995 to 27 billion in 1997. It's a huge drop. And as I mentioned, there was a mismatch on the balance sheet. So because domestic banks and finance companies borrowed in US dollars and they earned in Thai baht, that meant that your debt is actually in dollars, but you earn in baht, and there's a mismatch. So what happened was a lot of the financial sector's short-term debt exceeded the foreign currency reserves of the government, and that was a maturity mismatch because it basically owed a lot of money to the short term but didn't have enough reserves to cover it. And the current account deficit, of course, was financed by debt rather than FDI, so short-term flows. And after the exchange rate peg was abandoned, the real value of the baht fell. And what happened was, because you need more bahts now to pay for the same amount of dollar debt, it becomes much more difficult. And I think investors, of course, anticipated that, and that's what caused the run on the currency. At the same time, there was erosion of the policy credibility. So the reshuffling of the cabinet and collapse of the government. Of course, investors never like that because they like political stability and policy continuity. They don't like uncertainty. And whenever you have political uncertainty, it could cause economic uncertainty. Prime Minister Baron chose as his ministers mostly provincial bosses, and the short-term policies were driven by more patronage and particularistic connections rather than good economic policy. And for example, in 1995, the heads of 3 core macroeconomic agencies were fired, and the government was involved in 2 major scandals. And that dented confidence that investors had in the economy. So at the end of before the crisis, the credibility of the central bank was eroded. Foreign investors started to become very concerned with the practices of the Thai banking sector, which had borrowed lots of foreign currency and had accumulated a lot of debt. So there was a lot of concerns over the macroeconomic policy as well as credibility of some of the major financial institutions. So in summary, Thailand's crisis was a classic example of a balance of payments crisis in which there was an overvalued exchange rate, which caused a current account deficit as exports stagnated and imports rose. In order to plug the current account deficit, most of it was financed by short-term hot money inflows, mostly into the debt market. But because of the fixed exchange rate, there was a lot of rising debt because the corporate sector took on a lot of debt. They borrowed abroad at very low interest rates and deposited locally at higher interest rates, earning lots of money. But at the end, what we saw was investors starting to get jittery. They started taking their money out. Reserves started falling, reducing the external buffers of the Thai economy. There was also a mismatch on the balance sheet in terms of the currency and the maturity. So first of all, they borrowed in dollars but earned in Thai baht, so you had a currency mismatch, but you also had a maturity mismatch in the sense that the government's reserves were very low relative to how much debt was coming due, how much US dollar debt, so it was both currency and maturity. And of course, the last point was that in Thailand there was a huge erosion of policy credibility in terms of credibility of the central bank as well as government policy going forward. And all of these dynamics accounted for the vulnerabilities and the eventual balance of payments crisis in Thailand.